My background is that I've spent the last 18 years as an equity analyst, mostly covering TV networks and pay TV platforms, as Lorne said, most recently for Credit Suisse, based in New York. I covered stocks like Disney, Comcast, Time Warner, Fox, those names. Prior to that, I was at Credit Suisse in London, where I covered companies including Sky, Canal Plus, ITV, those names. So, and just, I'm sure you all know what an equity analyst is, but just for those who aren't 100% sure, my job is to talk to institutional investors, mutual funds, pension funds, hedge funds, to figure out what's going on in media and entertainment and advertising, and put numbers on it, and ultimately to give advice on what stocks to own and which to avoid. As Lorne said, I am now contracted to work at Morgan Stanley back in London, covering European TV networks. But just so I'm clear, and just from the perspective of the contract, I'm not officially a Morgan Stanley employee yet, actually until April the 3rd. So as of right now, just so you're clear, I'm unaffiliated, I'm not a Morgan Stanley employee, and nothing that I say today is attributable to either Morgan Stanley or Credit Suisse, just in case there's a Credit Suisse employee here anywhere. That's very important. Okay, great. So, no, seriously, it's very important. So here we are. That's the housekeeping out of the way, the legal housekeeping out of the way. Let's look at what I'm going to plan to cover for the next 30 minutes or so. Here's the agenda. Really, what I'm here for is to set the scene for the conference, to talk about the industry backdrop as I see it. Lorne and I just thought it would be useful for you guys, for me to take a step back and to paint a picture of the big industry trends that are driving US advertising. My objective really is to illustrate what I think is going on and to identify where the growth might be in the next several years. And as you'll see from this slide, I'm really going to talk about four things. First of all, I'm going to put where the industry is in an historical context. My thesis is that we're in what I describe in an age of relevance, where relevance is the most important basis of competition, as I call it, between competing advertising platforms. Relevance is what's driving market share, and the more relevant and targeted a platform is, the more chance it has of growing. Next, I'm going to talk about how I think about the marketing mix. I think, in essence, marketers have two objectives: to build brands or to get a consumer across the line on a purchase. It's the latter, which I call call-to-action marketing, where most of the disruption to advertising platforms is going to take place. And that's where most of the opportunity really is for you guys. And third, I'm going to quantify the opportunity. And I'm going to illustrate why I think the disruption to call-to-action marketing creates a $100 billion opportunity for platforms that can deliver relevant messages to consumers. This is obviously a central message for me this morning. And ultimately, I think there's, the simple way of putting it is that there is a mountain of money that's going to get shaken out of the marketing mix over the next 10 to 15 years. And I think that's really where the opportunity is for everyone in this room. And then lastly, I'm going to talk about which platforms I think are best placed to capture this opportunity. My view really is that the digital duopoly, particularly Google, is extremely well positioned, but that targeted TV could also grow into a substantial business long term, particularly given the innovations that we're seeing from Lorne's team and also from others in the marketplace, including OpenAP and Simon Media. So let's dive in. I want to start by looking at innovation and disruption for advertising platforms over time. When you look at the market share of different advertising platforms over the last 100 years, and trust me, I went back 100 years and looked at every cycle over that time period, you can see that there have essentially been three super cycles, where one feature of the different available platforms came to be the key basis of competition, which made their product offering superior to all others. As we show on this slide, first it was reach, then it was engagement, and now it's relevance. So radio took share from print, then TV took share from radio, and now digital is taking share from everybody. Crucially, the reason that the innovators are able to take share is because they harness technology to change the basis of competition between platforms by delivering something new of value to advertisers, which incumbents can't. Now, we all know that digital platforms are innovators today, but really their growth mirrors the growth phases we've seen in the past from radio and TV. So it's worth briefly understanding the dynamics. So looking at this slide, let's take radio. When radio emerged as a new advertising platform in the 1920s, it offered a new, unique selling point, the ability to deliver audio messages, which was fundamentally better than the incumbent media, print, where marketers could obviously only use text. This was an intrinsic competitive advantage for radio and allowed it to take share from print and grow from 0 to 20% of US ad spend over the next 20 years or so. Then with the advent of television in the late 1940s, that provided advertisers with another advance, again based on a new technology. This time, the ability to deliver messages to consumers with both video and audio, which made the messages fundamentally more engaging. This meant that TV at that point was the innovative medium because it offered superior utility versus the incumbent medium, which by that time was radio. And this drove TV's share of US ad spend from 0 to 25% over the next 35 years. And finally, since 2000, digital platforms have provided advertisers with yet another new innovation, the ability to deliver relevant messages tailored to specific groups of consumers. This step change in utility means that digital platforms can serve advertisers in a way that most traditional media can't, and this has driven digital platform share of US ad spend from 0 just over 30% in under 20 years. And as we know, Facebook and Google have taken 90 to 100% share of all the growth in global ad spend for the last 2 years in a row. What's happened is that reach has become ubiquitous, as has engagement with video and audio. Platforms which are providing relevant advertising are now the ones taking share, and they've changed the rules of the game for all advertising platforms. Relevance is the new basis of competition. That's what's driving share gains today, and in my view, that's what will be the primary driver of share gains between platforms for the foreseeable future. Ultimately, advertisers are voting with their feet and telling us what they want from platforms. The market share numbers tell the story. Anyone operating a platform which competes with digital advertising has to acknowledge that, and I think adapt their own advertising products accordingly. It's worth just finally on this slide noting the fourth supercycle that you can see on the far right. When you look at the academic studies of industry life cycles, what's apparent is at some point all technological innovations eventually become ubiquitous and products become commoditized. When this happens, the basis of competition simply becomes price. You've seen this in industries from semiconductors to farm machinery, and the point at which price becomes the driver of market share and the point at which that becomes the basis of competition is usually the right time as an investor to head for the exit, because that's when industry revenue growth slows and margins and returns on capital start to decline. Now, I think we're still a long way from that in the advertising industry, but it's a phase of development that all investors spend a lot of time thinking about. So to summarize what I started off with us on this slide, we've gone through cycles when reach and then engagement were the primary drivers of share gains. Those cycles are over, and we're now in a cycle where relevance matters most and drives share. If you operate an advertising platform, that's what you've got to respond to. So enough of history. What does this mean for how marketing spend might evolve in the future? The way I think about it is this. As I mentioned earlier, there are essentially two reasons an advertiser spends marketing dollars: to get a sale now or to get a sale in the future. As I show on this slide, you're either spending marketing dollars to call consumers to action or you're brand building for a future sale. And as I mentioned, it's call to action marketing on the right-hand side of this slide where relevance is the most important. The ability to target narrow groups of people is critical to the success of efforts to alert consumers to product attributes, to pricing, and to where they can buy. Digital platforms are obviously useful for building brands as well, but their real competitive advantage versus all other advertising platforms is the ability to provide relevant advertising, tailored to the specific needs and desires of individuals exposed to the marketing message. So for example, digital platforms can allow a fast food advertiser to reach a potential customer in their connected car with an offer as they approach a drive-through. Or an organic juice brand can display a reminder of the benefits of their product on a connected fridge of a consumer whose juice supply is running low. This is the functionality or the utility that all other ad platforms have to compete with. And that's why digital platforms, obviously particularly Google and Facebook, are well positioned to win call to action marketing money over time. And of course, they're only going to get better at targeting as we go forward because they're investing heavily in machine learning. As the amount of data that's useful to advertisers continues to multiply, wearable health trackers, connected cars, connected appliances, connected clothing, the ability of digital platforms to analyze this data with machine learning continues to improve. Obviously, the examples here are the combination of data from a connected car showing regular trips to a surf-friendly beach with a wearable device showing time spent in the sea, when combined can be useful to a whole range of advertisers. That's ultimately what platforms collecting this data can do. They have the ability to connect the dots and ultimately to serve the messages directly to consumers, and they are clearly going to be in a very strong position to dominate call to action marketing spend. Given that, it seems fairly clear that Google is particularly well positioned here. That's one of the reasons why, just to be clear, I think double-digit annual growth in digital advertising looks pretty unstoppable. But the important message is that although Google is going to significantly disrupt call to action marketing, what I show on the right-hand side of this slide, the door is open to other platforms to take share too. So let's be a bit more specific. What numbers are we talking about? These are the numbers that I'm sure you already know already. This is the Zenith data for US marketing spend last year. In total, just over $420 billion spent on marketing, of which just over $190 billion spent on media and roughly $230 billion spent on everything else. The standouts here are obviously the yellow and red segments in the bottom left-hand side of this chart. $56 billion spent on telephone marketing, $49 billion spent on direct mail in 2017, a touch over $100 billion in total. Staggering numbers when you look at them. If you think about the utility, effectiveness, and unit cost of telephone marketing and direct mail versus existing digital platforms, all the examples we were just talking about on the last slide, it seems pretty clear to me that just over $100 billion of today's marketing spend is going to be significantly disrupted over time. And significantly disrupted is just a polite British phrase. I think the American translation would be, it's all going away. If you're a marketer and you look at all the available advertising platforms out there, and you're allocating spend between brand building platforms and call to action platforms, it's very hard to see why that call to action money won't be sucked out of those two buckets into more efficient ways to reach consumers. This is going to include the digital platforms we know about today, but could also include targeted TV platforms as well. That's why I've talked about a $100 billion opportunity for targeted TV platforms. But just to be clear, it's a $100 billion opportunity for every platform capable of delivering efficient call-to-action marketing. So of course, digital platforms, especially Google, are in the fight for this opportunity as well. Our view is they're going to win a big piece of it. But targeted or advanced TV, whatever you want to call it, is the emerging advertising platform that I'm most excited about. One that I think that will surprise investors the most over the next 10 to 15 years. It's worth saying at this point that it's obviously not all a growth opportunity for the TV bucket. Clearly, there's a lot of call to action money today on old-style linear TV networks. It's hard to be certain how much of the $70 billion spent on US TV advertising today is call to action spend, but it's going to be at least 10%. When I think about how the industry is going to evolve, how the TV advertising industry is going to evolve over the next 10 to 15 years, I see pretty much all that spend migrating to relevant targeted platforms too. Some will go to targeted TV, but some will obviously go elsewhere. So let's talk about targeted TV. Clearly, the opportunity is to create an advertising platform which delivers messages to consumers using video, but to much more tightly defined groups of individuals than traditional linear TV. In simple terms, it seems pretty reasonable to think that platforms which combine the reach and persuasive power of video with the relevance of digital are going to be well positioned to win share. Graphically, this slide shows how I think about the main advertising platforms today. The more reach a platform has, the higher up vertically it is on this chart, and the more relevant the messages delivered on that platform are, the further right it is on this chart. So in the top right-hand quadrant, you have the platforms with the broadest reach and most targeting. In the bottom left, you have the lowest reach platforms with the least targeting or relevance. And the size of the bubble indicates the amount spent today. So digital platforms are intrinsically the most targeted and are growing in scale. So they are on the far right and they're moving up. Linear TV has intrinsically the broadest reach, and the opportunity is to move it to the right with more targeted, relevant ad products. And so if everyone in this room can find a way to create these products, targeted TV, we think, can offer advertisers a credible alternative to digital for their call to action marketing spend. The objective should be to give advertisers the ability to buy audience groups with specific attributes, not just based on Nielsen age and gender, and to deliver those messages around safe, engaging content without the elevated risk of ad fraud and to brand safety that you sometimes get with digital advertising. That's the challenge as we see it. And we really like what we're seeing Lorne and his team do. We also like the developments at OpenAP, the Comcast ATP suite, and independents like Samuel Media. This market for targeted or advanced TV is very much in its infancy right now. But with all the innovation that we're seeing, not least from the people in this room, my view is we're going to see a lot of growth. Now, I did publish a ton of long-term forecasts for platform growth, platform by platform, out to 2030, in a big report I published at Credit Suisse last April. Now, I'm happy to send out those forecasts to anyone who wants them. It's public documents, but I can't reproduce them here in this presentation, unfortunately. But what I would say is when you look at that $100 billion opportunity, I think targeted TV should win a big chunk of that money, with digital platforms taking the rest. Again, how much targeted TV actually does capture really depends on how the new products that you're helping to develop play with advertisers, and we'll obviously see over time. It's also worth saying at this point that I'm not the only one who thinks there's a big opportunity for targeted TV advertising. It's already driving M&A. You've seen, obviously, with the AT&T Time Warner deal, they specifically cited one of the rationales for putting that deal together was the opportunity for targeted TV advertising. The idea is that the data that's collected across AT&T's fixed and wireless telecoms networks, can be used to drive targeted TV campaigns on Turner. Also interesting, I think, will be how Disney's acquisition of BAMTech might drive the development of targeted TV products across their cable networks in future, with ESPN obviously likely to be the first on the list for innovation. That's not something they've talked about, but my guess is it's very much on their agenda. And the innovations that we're seeing in targeted TV are global. There's plenty going on in Europe too. Obviously, Comcast has partnered with European networks, including TF1 in France, Mediaset in Italy, to explore new ways of harnessing technology and data to make TV advertising more targeted. And of course, Comcast has just made an offer for Sky. Now, I covered Sky for 15 years, and you should know that they have a very well-developed targeted TV product called AdSmart. Whoever ends up owning that company will, I'm sure, continue to invest in that product across the footprint in the UK, Germany, and Italy, and will drive the growth of targeted TV in Europe for years to come. So really, there are a lot of forces that I think are going to drive TV into the upper right-hand quadrant of this chart, here in the US and in Europe. It's going to be everyone from networks and startup platforms to the big vertically integrated platform guys in the industry that develop new products for advertisers. And I think these new products stand a good chance of driving a lot of growth for the industry long term. Again, my job as an equity analyst is to identify these long-term trends which equity markets are missing. either under or overestimating in today's stock prices. One of the biggest themes I've highlighted to investors over the last year is the emergence of targeted TV advertising. If I'm right, I think ad revenues at some of the innovators in this space can grow materially faster long term than equity markets are pricing in, and I think should be a very positive driver for their stock prices. So we're bullish on targeted TV. Hope you get that message. But obviously nothing's easy, and there are always challenges to overcome as a new market evolves. So what are they? I've highlighted on this slide 4 issues that I think targeted TV platforms are likely to face over the next few years, as we show listed here. These are the issues that need to be addressed if this market is going to grow in the way that I think it should. So first, it's important that both buy-side and sell-side in the advertising industry agree standards for 3 things: audience definitions that will underpin guarantees, for third-party reporting that ensure advertisers can verify consumer exposure, and for proving ROI that connect that exposure to sales outcomes. So taking those 3 in order first, on audience definitions, one of the beauties of the current linear TV ad market is the ubiquity of Nielsen guarantees. They're inefficient, but at least everyone is certain where they stand. Now here, obviously, Lorne and his team are potentially in the running here, but we like what OpenAP are doing as well. And they're clearly pushing to be the new industry standard. There's a long way to go, and the door is open to everybody. On third-party reporting, advertisers have obviously publicly expressed dissatisfaction with some digital platforms on this point, and it's important that the targeted TV market takes advantage of this dissatisfaction. So I think effective third-party verification of consumer exposure will be an important differentiator for targeted TV. And again, we like the way OpenAP is set up, with Accenture performing that function. And on proving ROI, I think it's pretty obvious that digital platforms have trained advertisers to expect measurement of sales outcomes from campaigns. It's a given in digital. So I think the targeted TV market will have to find a way to replicate that. Here, we like what Simon Media have been doing, but again, my point is that in order to be successful, all platforms have to come up with solutions that serve advertisers in that way. Moving on to the second barrier to the development of targeted TV on this slide, I think one of the issues that advertisers talk about is the need for anonymity when they're negotiating audience guarantees for targeted campaigns. The issue here is that an advertiser may be disadvantaged if it goes to a sell-side platform with a narrow target demo, because the pricing is effectively bespoke and therefore pretty untransparent. One of the solutions to this was put together last year by Comcast with some partners in Europe called Blockchain Insights Platform. Perhaps that's going to be a solution to the advertiser concerns, but again, it's a potentially important area to address. And the last 2 issues on this slide I've highlighted are inertia, both from advertisers and from ad agencies. Specifically, I do think that ad agencies are potentially real drags on the development of this market. Remember that at a high level, of course, both advertisers and ad agencies love the status quo. It's easy, it's been done this way for decades, and change is hard. But it's also worth remembering that the media buying businesses of the big ad agency holding companies are under tremendous pressure on the digital side, particularly after the A&A report back in 2016 shone a light on the outsized margins they've been generating there in the US, thanks, frankly, to a lack of transparency in the supply chain. I think that right now, the last thing the agencies want is new pressure on their traditional TV buying businesses. So I think they're going to put up barriers and resistance all the way. So it's not going to be easy for targeted TV to gain the traction that I think it will and to get to the numbers that I've talked about. There are plenty of challenges to overcome, but Lorne and his team and other platforms I mentioned are doing great work, I think, to address them. So look, there's a lot more to say, but I'm conscious that, I don't want to overload you ahead of a very busy day. And so I'm just going to wrap it up with this slide with just a recap of some of the takeaways of what I've just said. First, we're in a cycle where advertisers value platforms which allow them to deliver relevant advertising messages. Relevance is the new basis of competition between advertising platforms, and it's driving market share. Successful advertising platforms have to acknowledge this and develop products which allow ad clients to deliver relevant messages to consumers. Second, there is a huge opportunity to disrupt what I've called call-to-action marketing spend. Existing call-to-action platforms, including direct mail and telephone marketing, are vastly less efficient than alternatives, and I think they could go close to zero long term. As things stand today, the digital duopoly is probably going to take the majority of this opportunity, but I do think that targeted TV should also take a big chunk, as long as standards, advertising anonymity, and advertiser agency inertia can be overcome. Third, the size of the opportunity for platforms that allow advertisers to deliver relevant messages is very substantial. There is a $100 billion opportunity of marketing spend that I think will get reallocated to these platforms. And if targeted TV develops the right products, I think it's in a good position to capture this money. And then finally, M&A will accelerate innovation in the targeted TV market. We think AT&T, Time Warner, Disney, BAMTech, and also Comcast are all going to push harder into this market, both in the US and in Europe. And I think the opportunity I've talked about resonates in boardrooms as much as it does for investors. And I think that in itself will help the market develop. Ultimately, I think we're very much in the early stages of a multi-year period of growth for targeted TV advertising. So I'm going to leave it there. I think I've said pretty much enough, lots of dense argument and a funny accent. So thank you very much for your attention at the beginning of the day. I'm happy to take questions now, or if you prefer, I'll be around for a little while during the day. So please feel free to come up to me and ask me any questions if you have them.
Great.